What's up, guys? Welcome back to my channel. My name is Robert Fitzpatrick. I am a licensed real estate agent in the DFW area, and today we are going to be talking about FHA loans. I know so many people that are confused at what exactly is an FHA loan. I hear people saying this is a first-time home buyer's loan, and if you're a first-time home buyer, you need to get an FHA loan. That's not true. Okay, I don't know where you heard that, but we're gonna debunk that today. FHA does not stand for a first-time home buyer loan. Okay, that's not even the right acronyms. Okay, so I'm just gonna go over what it takes to generally qualify for an FHA loan and how an FHA loan may be the right choice for you when you're thinking about buying a property, and I'll also give you a personal story of some times where clients have used FHA loans and it worked out great. Okay, so before we get into it, make sure you hit that like button, subscribe, let me know what type of content you would like me to cover. All right, let's get into it. What is an FHA loan? So an FHA loan, FHA stands for Federal Housing Administration. And the way that it works is an FHA loan is not given by the government. An FHA loan is just pretty much insured by the government. The government backs this loan. So essentially what that means is that if you, as the buyer and holder of the mortgage, if you default on it, the government is then going to pay the lender or the bank or the institution that issued the loan or whoever's holding the note. They're going to cover it. So essentially it makes it safe for people doing FHA loans to get these loans because they're backed. So it works out for the lender, it works out for the buyer, because the government is coming in saying, hey, look, if something goes wrong, we've got your back. Okay, so that's a broad, simplified analysis of it. Of course, when I take my courses and I do my studying, they go into way more detail, but for the purposes of this video, that's essentially what an FHA loan is, okay, and how it came to be. All right, so let's get into the real stuff. How can you get an FHA loan if you are trying to buy a property? So first, FHA loans must be used for your primary residence, okay? And when I say primary residence, I don't mean just on paper. I don't mean, yeah, I'm gonna get this FHA loan, say I'm gonna live there, and then I'm gonna go live with my cousin or my mom and then rent the property out and make cash flow and run the play and do what these gurus are saying. No. Okay? FHA loans are for people that are trying to purchase a primary residence for them to live in, okay? That is what they are for. Now, I know some people are going to say, well, what about when I run the play and I get a duplex or a triplex or a quadplex and I rent the other units out? We'll get into that, okay? But I'm specifically talking about a one-unit, single-family home. You are not supposed to get this loan and then rent the property out and never stay there. Now, you can do that after a certain time frame, okay? But the idea is that this loan is not for investments. This loan is for people purchasing a primary residence. All right, so credit score. Generally, you want to have about a 580 on the low end, okay? That's the minimum. It's typically a 580. Some lenders do go below a 580, but it typically requires a higher down payment, okay? 3.5%, that's what the down payment's gonna be if you have a 580 or above. 3.5%. Now, it can go a little higher in terms of the down payment. That can go a little higher depending on if you've had some issues, right? Depending on income. All these different things, they're called different factors, right? Compensating factors. What is your buyer profile looking like? And that will determine around what the down payment you should have. Okay, so 580 credit score. Also, They want to see that you have stable income. Now, stable, it can be very subjective, so this is why it's important to talk to your lender. But they want to see that you've worked in the same industry for quite a while. They want to see that you have been getting some form of payment over a certain amount of time, and they're going to ask you questions. So if you switch jobs recently, they're going to want to know. Not only are they going to want to know, they're going to want to they're going to want you to prove where you were employed if you're switching, right? They're going to want numbers. They're going to want people to contact. They want to make sure that they're going to get paid. And so they're going to look at your income. They're going to see how much money you're making, and they're going to see how long you've been employed, but also what industries. Because in some cases, if you're switching industries, that can be a red flag. So, employment, steady income. Also, your debt to income. Debt to income is simply how much debt do you have relative to your income. So, if you make $2,000 a month gross, because they're going to go by your gross income. For those of you who don't know what gross income is, gross is before taxes. Net is after taxes and deductions and all the other things that you have. Okay, so they're going to look at your gross income and they're going to say, okay, you make $2,000 a month, but looks like your credit card payments and your student loans and your buy now, pay later things that are showing up on your credit lines, those equal $1,000 a month. So now you're at 50% debt to income. And this is not including the debt of the property. Okay, so there's something called front end debt and back end debt. They're going to look at both. Your front end debt, based on my understanding, is what is your mortgage payment relative to your income. So, for example, if your income, your gross income is $2,000 a month and your mortgage is going to be $1,000 a month, your front end is going to be 50%. Okay? So they're looking at that. There's a limit for the front end and on the back end. So if you have a 50% front end, that means that even if you have no other debt, because the front end is just looking at what is your mortgage payment going to be, what is your housing payment going to be. That's the front end. The back end is all the other debt, right? Plus the mortgage. So if your front end is too high, that can disqualify you. And if your back end is too high, that can disqualify you. So typically, what they want to see with an FHA loan is that your back end is no greater than 43%. Okay, and this is just a guideline. No greater than 43%. I know some lenders, they go up to like 55.9. They kind of stretch it, but these can be extenuating circumstances. In general, they want you to have less than 43%, and I'm going to provide a link in the description so that you can actually go on the FHA website and see the guidelines for yourself. Also, okay, when it comes to your debt, if you are paying down debt, you are going to have to time it and make sure that it's actually showing up on your credit report. Meaning, if you have to pay down debt, you're going to need to show proof. But also, if your credit score is too low at the time, even if you pay that debt down, it still may take time to hit your profile. So make sure that if you are thinking about buying and you're thinking about paying debt, that you speak to a lender to see what is the time frame that it's going to take for this to actually fall off so that it reflects in my credit report. Okay. So, moving on from the debt part, all right? We're going to talk about mortgage insurance. So an FHA loan, that requires mortgage insurance premium, all right? And pretty much what that is it's a payment that you are going to make for mortgage insurance. This mortgage insurance is covering the mortgage in case you default on the mortgage. Your loan officer or lender or bank, they can go over exactly what that's going to cost you. I believe there's an upfront fee of 1.75%. I don't know if that's changed, but last I checked, it was like a 1.75% of the loan, and I believe that can be rolled into the loan, but I would double check with your lender on that. Okay, so who should get an FHA loan? Here's who should get an FHA loan. If you are purchasing a primary residence and you are looking for a loan that has a low down payment, low closing cost, and you are also going to be living in the residence as your primary residence, an FHA loan could be a great option for you. Okay, it can be a great option for you. There's not this is only for first-time home buyers, or I'm less than. It all depends. Here's a stereotype that I'm also going to address. Within the real estate market, okay, when you're shopping for a home, I know a lot of buyers believe that if you have an FHA loan, sellers are not going to want to work with you because they look at it as a government loan and they think that there's all of these things that come with it that you're not going to have to deal with. Listen, if you're a seller and you are selling a quality property, you're not going to have any issues with somebody using an FHA loan, okay? You're just not. FHA loans are great loans. They're great. They allow a lot of people to get into the housing market, and at the end of the day, you are benefiting as a seller if you work with somebody who's getting an FHA loan, because what we understand is that government doesn't want to lose money, lender doesn't want to lose money, nobody wants to lose money. And so FHA loans, we have to get rid of this stigma around FHA loans, because they do not mean someone cannot afford a house and this is just a handout or anything like that. FHA loans are great loans. So I hope that helps. If there's anything else that I can cover on FHA loans, let me know in the comment section and I will do my best. Like, comment, subscribe, all that great stuff, and I'll see you in the next video.